I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a real treat. Haven't had him on for a while, but five-time best-selling financial author. His latest book, which comes out next week, The New Great Depression. Please note the mask. This is the big reason why we're going to have the new Great Depression. Jim Rickards, thank you for joining us today on USAWatchdog.com. Always a pleasure to have you on.
Thanks, Greg. Great to be with you again.
Just so people know, too, I mean, some of the books, one of them I don't have Currency Wars, but, you know, The Death of Money. We're going to talk about gold, all bestsellers. Here we have The Road to Ruin, and, of course, Aftermath as well, all best-selling books. And Currency Wars on top of that, another best-selling book. You know your stuff about what's going on. Let's start with how fast you put this book together. I mean, this pandemic debacle has come on us like a wildfire, and it's really caused a lot of problems. Huge unemployment. 20 million people were unemployed at the end of 2020. We had another fresh 787,000 filed for new claims right at the last week. Things are, no matter who is elected president, it's all up in the air about who's going to do what. No matter who is elected president, you say it doesn't matter. Why?
Well, the reason is that, again, it looks like Biden, but, Trump's got a couple, wild cards here. They're still fighting it out in the Congress. So we'll see. But let's just assume it's Biden. But even if it were Trump, the point is fiscal policy will not solve the problem, and monetary policy will not solve the problem. And I know those are categorical statements. I explain why in my book, The New Great Depression, in great detail. But the point is, people keep saying fiscal stimulus, monetary stimulus. There's no stimulus. Now, you can engage in deficit spending, and they are. We had a $1 trillion baseline budget deficit for fiscal 20 and fiscal 2020 and fiscal 2021. So you're starting $1 billion in the hole. $1 trillion in the hole. $1 trillion in the hole for openers. Now, in last year, they threw $4 trillion on top of that with the CARES Act and a couple other relief bills. Now the Congress is throwing another trillion, about $900 billion on top of that, but we can expect more coming. So can they run huge deficits? Yes. Can they spend money? Yes. But the point is, it's not stimulus. It's not going to stimulate the economy. You can think of these as bridge loans, get us through the next couple of months. You put a check in everybody's mailbox. Okay, that's helpful, but it doesn't solve the problem. It doesn't create growth. It's not permanent. What are you going to do 6 months from now? Do another trillion? I said this last spring, by the way, when I was writing the book. And the book is, we were working on it through October. We can talk a little bit about that. But when it first came out, I said, okay, the payroll protection plan is a 2.5-month bridge loan. That was actually the formula for how much you got. Take your payroll times 2.5, and that was the amount of loan that you qualified for. Those loans are pretty much going to be forgiven. Well, that got you from April to June or July, and the thought was, all right, it's really bad in March and April. Everything was quarantined, locked down, but it'll be better by the summer. So let's give everyone kind of a 2.5-month bridge loan just to get us to the summer, keep people on the payroll, and we'll take it from there. It'll be better in the summer. Well, it wasn't. We got to the summer. They did the so-called reopening, and the disease started spreading like wildfire again, which I also predicted in the book. And then by October, November, it was worse than it was in March and April. The number of new cases, the number of fatalities, the crowding in the hospital rooms, et cetera, the intensive care units, it was worse. So all you did with the lockdown was I sort of pushed back the inevitable. Lockdowns don't work, and I talked about that in the book as well. Okay, so here comes another $1 trillion, so-called stimulus. It's not stimulus. Another $1 trillion of assistance. Okay, but all that's going to do is get you a couple of months down the road. None of these things solve the problem. There's specific reasons for that. Flip over to monetary policy. Now, in the 2008 financial crisis, the Fed's balance sheet was $800 billion at the beginning. They took it to $4.5 trillion by 2015. That was the end of 2014. That was the end of the taper. Then they tried to reduce it. They tried to normalize. They made some progress. They got down to about 3.7 trillion. But boom, here comes the pandemic in 2020. They took it up to 7.5 trillion. So they printed $4 trillion since the onset of the pandemic. But that doesn't work either. And the reason for that, Greg, just to be specific, everyone thinks, the Austrians, the monetarists, the Milton Friedman groupies, the neo-Keynesians, they all think that printing money causes inflation, and it doesn't. Printing money does not cause inflation. What causes inflation is what's called velocity, which is the turnover of money. So think of money as a pile of wood. So you keep printing money, you're building up a bigger pile of wood. Well, that doesn't start a fire. It's just a pile of wood. You need a spark, a lightning bolt, a match, blowtorch. You need something to start the fire. The something is not the wood. It's in this case, it's actually the velocity, which is a psychological phenomenon. The Fed can't control that. The Fed can control the money supply. They can make it whatever they want, but they can't cause inflation. To do that, you need a change in people's behavior, and that's what velocity is. I explain it very simply. So let's say I go out to dinner and I tip the waitress, and the waitress takes a taxi home and she tips the taxi driver, and the taxi driver takes the tip money and puts gas in his car. Well, in that example, my dollar tip had velocity of 3. There was the waitress tip, the taxi tip, and the gasoline. So my $1 produced $3 of goods and services. That's velocity. But what if I stay home and watch TV and don't go out and don't spend any money?
Oh.
In that case, my money has velocity of 0. And calculus is good, integral calculus is fine, but you don't need it. 5th grade math works fine. $7 trillion times 0 is 0. In other words, if you don't have velocity, you don't have an economy. So the 7 trillion, which is the base money supply, could be 8 trillion, could be 9 trillion. And my friend Stephanie Gelton would say, make it 10 trillion, why not? But that by itself does not produce inflation. What you need is the turnover, but we're not getting that. Velocity actually has been dropping since 1998. It dropped steeply in the 2008 financial crisis. It dropped steeply again in the 2020 pandemic, which is ongoing. But it didn't start with either one of those crises. It started in 1998, probably for demographic reasons and other reasons that are a lot bigger than the pandemic. But the point is, all the money printing just offsets the drop in velocity, and you don't get inflation. You don't get nominal GDP, and you're not going to until there's a change of psychology. But right now, the psychology is the opposite. Everyone's saving. I'm not saying saving is a bad thing, but if you're saving, you're not spending. And if you're not spending, the economy's not growing.
You had said at one point in an interview, and I remember this like it was yesterday, and you said, the Fed balance sheet is 4.5 trillion. The next time we have a problem, are they going to raise it to, 8 trillion, 9 trillion? And I think even you are surprised. And the answer is yes.
Yeah. Well, the answer is yes. And then the next logical question is to go, is there a limit to that? The answer is there is a limit. It's psychological, but it's also invisible. So I can hypothesize a limit. There is a limit, but we're not going to know until we get there. And going back to my metaphor of a big pile of wood and we need a match, well, this is where money supply does matter. If that match comes along, if that change in psychology comes along, you could have the biggest fire you ever saw. So right now, 7 trillion, and if they want to make it 8 trillion, they probably will, or 9 trillion. By itself, does not cause inflation. But if that catalyst comes along, that change in inflationary expectations, the match, as I call it, you could see the biggest inflationary fire you've ever seen. So my expectation, I talk about this in chapter 6 of the book, initially, the problem is deflation, not inflation, but deflation. Too much debt, growth is too slow, the psychology is wrong, people are saving, not spending. Greg, you go to these, last spring, everybody got a $1,200 check. Under this new legislation just passed, everyone's going to get a $600 check, although they're fighting over whether it should be $2,000. But whatever it is, the idea is, well, we're going to send these checks out and everyone's going to run right down to Walmart and buy all this stuff. No, they're going to get the checks, but they're either going to pay down debt, which is reducing your balance sheet. Paying off debt is the same as savings economically. It's not spending. You're shrinking your balance sheet. You're deleveraging. Or people are going to save it. Which is, again, not a horrible thing, but it's not spending. And you know what a lot of people are doing? They're opening accounts on Robinhood and buying, Tesla. People have never traded a stock in their lives, don't really understand necessarily how stock markets work. But, you're talking about, millennials. I don't want to pick on millennials. I have 3 millennial children, Generation Z. But these are people who grew up on video games. And all of a sudden they get these $600 checks like, well, I don't want to spend it because, who knows, maybe I'll lose my job. Maybe I don't have a job. But they open one of these Robinhood accounts and they start buying call options. And guess what? The stock market goes up. and they say, hey, I just made some easy money. And then they buy more, et cetera. Of course, that'll go on until they get wiped out. But the point is, you get a trade. I use trading screens all the time, because I do economic and capital markets analysis. But there's a generation that gets a trading screen. It looks like a video game. It's got lights, it's flashing, changing colors or whatever. That's not what everyone's doing, but it's part of what people are doing. And people say, gee, well, if you lost your job, wouldn't you save more? Well, of course you would. But even if you didn't lose your job, you might save more because you're worried that you might lose your job. This is what economists call precautionary savings. You don't necessarily need the money right now. I can pay the rent, but who knows? Maybe something bad will happen. So I'll save anyway, just in case. Precautionary savings. That's what people are doing with the money. So that's one of the reasons all these checks, all this deficit spending doesn't work. All the money printing doesn't work. Now, what would it take to change the psychology? That's the big question. The Fed doesn't know. The Fed needs inflation, but they haven't been able to get it for 13 years, and they're not going to get it now.
So this brings me to my next question, and I'm fascinated by it because you wrote a book about this, and I know you're a proponent for gold. And if you take a look at, so people can see it, the new case for gold, and I think you're still, back in gold because gold works well in deflation. People don't realize that, but all my guests say the same thing. It works well in deflation. People don't realize that. Hey, but you have Bitcoin went from 10,000 3 months ago, and now it's at $33,000. Gold was up 27%, but nothing like Bitcoin. But it's approaching, the 2,000 mark. We're getting into nearly all-time high scenarios. Silver's at 27. What's going on with gold and silver?
Well, gold and silver are going up. They're, in last August 2020, gold hit a new all-time high. Silver is not at an all-time high, but it has performed very well this year. Actually, if you break down asset classes, silver, gold, stocks, bonds, government bonds, emerging markets, oil, et cetera, the number one performing asset class in 2020 was silver. And the number two was gold. Silver was up about 47%. Gold was up about 25%, give or take. It could have been 27%, but somewhere in the mid 20s. Outperformed stocks and all the other asset classes. But they're going to go a lot higher, and they have to, for reasons I explain in the book. I talk about this in chapter 6 and also in the conclusion. And let me just step back a little bit, Greg, and kind of give you why, because I don't like to throw things like that out there without backing them up with analysis. Anybody can make a big claim, say, oh, gold's going to $10,000 an ounce, gold's going to $15,000 an ounce. By the way, that is my forecast, but you have to be able to back that up with some analysis. So let me do that at two different levels. One we sort of talked about, I said, deflation is a bigger problem than inflation, but you need inflation. Everyone hates inflation. Well, yeah, I do too, but you've got $22 trillion of debt. The U.S. debt to GDP ratio is approaching 130%. Who's the peer group at 130%? Well, it's Lebanon, Greece, and Italy and Japan. So there's your club, right? It's kind of the league of super debtors. But the problem is, and the research is very clear on this, when you go past 90%, so I'm talking about, take the national debt and divide it by GDP. So how much debt do you have and how big is your economy? It's pretty simple. When that number goes above 90%, when the debt is more than 90% of the GDP, growth slows. There's no more Keynesian multiplier. The Keynesian multiplier says if I borrow $1 and spend $1, I'll get $1.20 of growth. Or if I borrow $1 and I spend $1, I'll get $1.10 of growth. That can work at certain levels of debt. It's not a general theory. It is a special theory. So if your debt is low to begin with, you're coming out of a recession or you're in a recession, you're in a liquidity trap, which we just talked about. People won't spend the money. And so you say, okay, the government can spend the money. And if we borrow and spend, can we get more? If we borrow and spend $1, can we get more than $1 of growth? Well, the answer is you can, at least temporarily, with those initial conditions. Those initial conditions do not apply. The debt is not low. It's huge. The debt to GDP ratio is not 30%. As I say, it's 130%. The evidence is once you go past 90%, that multiplier drops below 1. In other words, now you borrow $1, you spend $1, and you get maybe 90 cents of growth or 80 cents of growth. You're no longer in the plus category of $1.20. you're in the negative category of 80 cents or 70%, 70 cents as the case may be, which is why you cannot borrow your way out of a debt trap. You cannot spend your way out of a liquidity trap when you're in this deep. And the United States is. So again, as I said, it's why monetary policy doesn't work. Now, what can you do about it? What you have to do is inflate the debt away. So I said the debt's 22 trillion. That's about right. 4% inflation for 17 years cuts the value of the dollar in half, which means the real value of the debt is cut in half. So you would still owe $22 trillion. I mean, we'll owe more because we'll have bigger deficits in the future. But, from a standing, if you keep that number fixed, you'll still owe $22 trillion, but it'll only be worth $11 trillion because you will have devalued the dollar by 50%. That's what you have to do. That's what the country did after World War II from 1950 to 1980 before we started going in the opposite direction. Okay, so that's just math. I mean, that's not that complicated. The question is, how do you get 4% inflation? Because the Fed hasn't been able to get 2% inflation for 14 years. I mean, they hit 2 for a couple of months. That was about it. The Fed shows they can't do it. Well, you can do it, but what you have to do is raise the price of gold. And everyone says, oh, gold's going up. Isn't that wonderful? Yeah, that's one way to think about it. And I own gold, and I recommend gold, for 10% of your portfolio. But here's the point. When the dollar price of gold goes up, gold's not really changing. Gold is gold. It's an element, atomic number 79. If you have a gold coin, stick it in a drawer, close the drawer, go away for a year, come back, open the drawer, it's still one gold coin. It didn't multiply into 2 or 3, etc. So gold is the constant. It's your yardstick. So when the dollar price of gold goes up, what's really happening is the dollar is devaluing. And that's the key, because when you devalue the dollar, you reduce the burden of the debt. It's still 22 trillion in my example, but it's a lot easier to pay off. And the Fed's trying to do that, but they can't. They've forgotten how. I mean, the reason is they don't have gold in their mindset. They're looking at the euro. They're looking at money supply. They're looking at phony baloney, Keynesian multipliers, none of which applies. The Fed hasn't caught up to the fact that none of their models work anymore. Maybe they never work. Some of them never work, but the standard models don't work once your debt to GDP ratio goes past 90%. That's where we are. We're in that negative, or not negative, but less than 1 multiplier zone right now. And again, the research from Ken Rogoff and who is at Harvard, and Carmen Reinhart, who's the chief economist of the World Bank, shows this. It's all in my book, by the way. It's all in the endnotes. I always tell people, Greg, there are about 200 endnotes in this book. The endnotes alone are worth the purchase price. Now, of course, I want everyone to read the book, and I hope they do, and I hope they get a lot out of it. But if you just had those endnotes, go look at that research. You'll see the backup for everything I'm saying. So you can't. So you need to inflate your way out of this, but you can't do it with money supply. You can't do it when the psychology is so bad. You can't do it when people are saving and not spending. The way you can do it is changing expectations, and the way to do that is to increase the dollar price of gold, because it's not about making gold go up. It's about making everything go up. But you start with gold because that's your benchmark. And so what I say to the reader is the Fed has forgotten how to do this. They could do it. I doubt they will, because their models are all wrong and they don't know what they're doing. But you can do it. You personally, individually, can put gold in your portfolio and benefit from an increase in the dollar price of gold. It's going to happen. Whether it happens in a kind of chaotic, sloppy way, because people lose confidence in the dollar, or it happens in a disciplined way because the Fed reads my book and understands how to do it, is hard to say, but it's going to happen either way.
And you say that gold's going to hit $15,000.
Yep.
Wow.
Well, that's a couple things in that. Great. That's not a number I pull out of the air just to attract attention. I could care less about that. There's good math and good science behind that. And let me kind of back that up a little bit. So if you just took the official gold supply, it's about 35,000 metric tons. I mean, we know this. And then the official money supply using M1, which is one definition of money, and from the major central banks, so ECB, Fed, People's Bank of China, Bank of Japan, Bank of England, a few others. That number is about $30 trillion. And here I make an assumption. If you assume 40% backing, so we want the market value of gold to be 40% of global M1. We think that's enough gold to support the economy and to support the faith in the currency. Well, it's simple division. What is that number? Well, the answer is $15,000 an ounce. So
Wow.
that is if gold is less than that, you're going to have to reduce the money supply, which is a disaster. That's deflationary. You don't want that. You want it to be, first of all, inflationary in the first instance and then stable thereafter. The implied non-deflationary price of gold is $15,000 an ounce. Now, if that sounds like pie in the sky, let me give you a little more. Again, I like to stick to fifth grade math if I can. I'm fine with calculus, but we don't need it. So right now, gold it's about $2,000 an ounce. It's a little bit less than that. It's around $1,900 an ounce, but let's call it 2,000 for a round number. If gold goes from $2,000 an ounce to $3,000 an ounce, that's a 50% increase, big percentage increase. But if gold is $14,000 an ounce and it goes to $15,000 an ounce, that's only a 7% increase. In other words, what people don't get is that it's still $1,000. If you own gold, you still made $1,000 an ounce. That's real money. But as gold goes progressively higher, each additional $100 or $1,000 increase is a smaller percentage gain. 7% is like 1 week's volatility. So you know the old line from The Sun Also Rises by Ernest Hemingway. The two characters are talking, and one guy said, "How did you go bankrupt?" And the answer was, "Slowly at first, and then quickly." Same thing with the price. It'll have to chug its way from 2,000 to 3,000, but once you're up at 10,000, going to 11 is just a 10% gain. That's like 1 week's volatility. So it'll happen very quickly at the end. All the more reason to have gold today.
And do you like silver as well? A lot of people be sitting here. What does he say? Think about silver.
Yeah, silver's more difficult to analyze because gold actually isn't good for anything except money. It's gold is the best form of money, but it's not good for much else. It has some very specialized applications, but not many. People say, "What about the jewelry industry?" Jewelry is money. It's you get to wear it on your wrist. You know, you get a bracelet or a necklace, or you're an Indian bride, you drape it around your sari or whatever. But jewelry is wearable wealth. It's just another form of bullion. But silver has industrial applications, a lot of them. So when you're analyzing it, it's a precious metal and an industrial input, a little more difficult. But silver's along for the ride. There's no way that gold's going to $10,000 or $15,000 an ounce without silver going to $100 an ounce. So, pardon me, a little more difficult to analyze, but silver's along for the ride. Silver's going to go up a lot also, and I like silver.
The dollar. You talk about the dollar going down since election day. I mean, it's down below 90. I know you've
Yep.
followed this. It's down more than 5% since election day. I don't know if that's what they want for the world's reserve currency. I know a lot of people are de-dollarizing. I had Catherine Austin Fitz on saying they'd love to get away from the dollar, but it's dominant.
Yep.
But how does that play into your scenario of inflation? That gold is, that dollar is down 5.5% or something since election day, since November 3rd.
Well, there's a very famous jazz song. You may have heard it, Greg, or jazz fans may be familiar with it. The title of the song is "Compared to What." It was played at the Montreux Jazz Festival, I think, in 1967. But it's a very well-known song. So when people say dollar's down or dollar's up, I look at them, I say, compared to what? So the dollar index you're talking about, I don't think it's very meaningful. I do follow it. I absolutely watch it. It's on my trading screen. But
The Dixie, DXY.
well, whether you take the Dixie, the Bloomberg index, the Fed index, there are a bunch of dollar indices out there. Take any one you want. They're all basically the euro US dollar cross rate. Because the dollar is 60% of global reserves. The euro is about 30% of global reserves. So those two currencies alone are 90% of global reserves. All the rest, sterling, Swiss franc, Canadian dollar, Australian dollar, Japanese yen, Chinese yuan, which is kind of a joke, but all of them together have to squeeze into the last 10%, most of them in single digits or less. So the whole world is about the dollar euro. So all these indices are the euro dollar cross rate. But the thing about currency cross rates is you're comparing two things with no independent yardstick. So the way I describe it, the euro, the dollar, the yen, pound, Swiss franc, whatever, they're passengers in a lifeboat. And some are taller, some are shorter, some are smarter, some not so much, some are better looking than others. But you're all in the same lifeboat. You're going to sink or swim together. There's no world where confidence in the dollar collapses and everyone says, "Give me that euro." No, if confidence in the dollar collapses, confidence in the euro is going to collapse. The cross rate will bounce around. It matters if you're an exporter or you're a trader or whatever, but they're all in the same boat. There's only one objective yardstick. There's only one way to measure whether all the passengers are going to survive or sink, and that's gold, because gold is not controlled by a central bank. It's not a fiat currency. It's not printed. You can't expand it or contract it the supply at will. Actual mining output is about 1.6% of above ground supply, which is tiny. Yeah, there is mining output, but that's actually about equivalent to world population growth and
Wow.
non-inflationary economic growth. So that's one of the attractions of gold. But here's the point, Greg. Yeah, the dollar will go down and then it'll come back again, and it'll go down and it'll come back again. The dollar, you look at the history of the euro going back 21 years at this point. The euro opened at $1.16. It traded as low as 80 cents. I was in Europe when it was 80 cents. It was great because you go out to the best restaurant, have a 4-course meal, wine and tip, and you couldn't spend $100 for a party of 6 if you tried. So that was fun. But then it went to $1.60. But it's never gone past the $1.60, and it's never gone below 80 cents. So it trades in that range. Currencies don't go to zero, and they don't go to the moon. Apple stock can go to the moon. Some bank Hertz can go to zero. But major currencies don't trade that way. They trade in a band. So, okay, it's down a little bit. That is mildly inflationary, but it's bad for Europe, right? Because if the euro gets too strong, then they're importing our deflation, and we're importing their inflation, which is, we say, is what we want. But what happens when Europe collapses? Who's going to buy our stuff? And so these things just go back and forth, and they are manipulated by central banks under swap lines and other mechanisms. The only objective measure of any currency is gold. By the way, the only way you can devalue all currencies at once is against gold, because if you make the dollar weaker in your index, you're making the euro stronger. That only goes so far. You're going to sink Europe. If you make the yen stronger, you're making the dollar weaker. And again, that only goes so far because you're going to sink Japan. And so there are limits on all this. So they don't actually mean that much in terms of changing the shape of the world. But gold does. Gold is the only form of money where every currency can devalue at the same time. Otherwise, it's a mathematical impossibility.
One of the things you said in a past interview, and I want people to bring this out because a lot of people say that, and you know the truth when you hear it. And when you said this, I went, yeah, that's the truth. And you said, listen, the United States isn't that stupid to sell all of its gold. We didn't. It didn't happen. The United States has its gold. Talk about the United States having gold. Do we have our 8,000 metric tons plus of gold in Fort Knox or somewhere in West Point or wherever?
Yeah, somewhere is a good way to put it. We do have it. About half the gold, a little bit less, is in Fort Knox, but the remainder, another 4,000 metric tons, is at West Point. The exact location, I happen to know it, but it's classified, so I can't mention it. And then there's a little bit at the Denver Mint, but not that much, and a tiny little bit at the Fed. People look at the Federal Reserve Bank of New York. People look at the Federal Reserve Bank of New York, and there's 6,000 tons of gold. Well, there is. I mean, there's 6,000 tons of gold in the Fed vault, but it's not our gold. It's except for a tiny sliver. It's other people's gold. That gold belongs to the IMF. It belongs to countries around the world who don't trust their own governments. So it's a custodial facility. There are 6,000 tons there, but it mostly belongs to other countries. But the U.S. gold, now the history of that's interesting. In 1950, the U.S. had 20,000 tons of gold. That was after World War II. Okay, by 1970, we were down to 9,000 tons. Well, where did the 11,000 tons go? Well, that was the heyday of Bretton Woods, and in those days when the U.S. ran a trade deficit with a country, which we did because we were trying to help them, and they got dollars because they were selling us, transistor radios, Volkswagens, French wine, whatever it was. They sold us stuff. They got the dollars. They could cash in the dollars for gold, and they did. France, round numbers, France got 2,000 tons, Germany got 3,000 tons, Italy got 2,000 tons, Netherlands got 600 tons, Japan got 600 tons. So the gold went to our trading partners, and that's what Nixon changed on August 15th, 1971. He said, no more. He said, you can have dollars, pardon me, and you can buy, real estate or stocks or bonds, but you can't get the gold anymore. He shut the gold window. So we lost another 1,000 tons between 1970 and 1971. Then they shut the window. Now, here's the point. The U.S. did sell a little bit of gold in the late 1970s because we were trying to manipulate the price. But by 1980, we were down to that last 8,000 tons, and we stopped. But what we did was interesting. We still wanted to suppress the price, so we got everyone else to do our dirty work. Well, who was everyone else? Well, remember late 1990s?
Bank of England.
the UK sold half their gold, more than half their gold. That was Gordon Brown, was the Chancellor of the Exchequer. They call it. He managed to pick the bottom. They say it's hard to pick a bottom. He did it at $250 an ounce. Boom, sold it at the absolute bottom. But in the early 2000s, the UK was out of the game because they had sold most of the gold. We got Switzerland. Switzerland sold 1,000 tons, and then there was a popular backlash in Switzerland. And then finally in 2010, we got the IMF to sell 400 tons. By the way, the IMF still has over 2,000 tons. They keep disparaging gold. Well, okay, if it's so worthless, why do you have 2,000 tons? Well, the answer is it's not worthless. But that was it. 2010 was the last time that the IMF and the central banks were net sellers. Since
Wow.
then, they've been net buyers. Now, not every central bank bought gold, but Russia, China, Vietnam, Mexico, Kazakhstan, Turkey, Iran have all been buying massive amounts of gold. And so if economics first week, you learn supply and demand. Well, okay, if the supply is growing at 1.6% and the demand is growing, exponentially because central banks are buying it in addition to institutions and individuals, what is that going to do to the price? It's going to go up. I mean, obviously, that's how you adjust supply, demand, imbalances with a higher price. And so the weight is all on the side of higher gold prices. Now, again, it doesn't happen at once. You got the paper gold market to fight. You got investor perceptions. If you talk the way I'm talking right now on your show, Greg, the people call you a gold nut or a Neanderthal or whatever. And I love when people say, well, Jim Rickards is just talking his position. He's just trying to sell you gold. I'm not a dealer. I don't sell gold. We buy gold, don't buy gold. That's up to you. I mean, but I don't, I'm not a dealer. I don't get commission. I don't get paid. I'm a writer and I'm an analyst. I do recommend gold, but I don't make any money if anyone buys gold. So that's up to you. But I do recommend it if you want to preserve wealth and not get wiped out in the years ahead.
And I wanted to talk a little bit about what people should do. Obviously, buy gold, buy silver if you can handle the volatility. But you think people should they pay off their houses? Is the dollar going to go away? So evidently, the dollar will not go away. You may be cut in half, but you can hold dollars if you really wanted to.
Correct. For a while, it's not invulnerable, but again, the dollar is 60% of global reserves. It's about 80% of global payments. And here's the thing, Greg. My wife hates for me to admit this, but in the 90s, I was a registered lobbyist. I had a Washington office. I spent a lot of time on Capitol Hill, and I learned a thing or two. And one of the first things I learned in Washington is you can't beat something with nothing. If you really dislike something, you dislike some policy or some law or whatever it is, and I hate it, and you write out op-eds and you rant, right? Fine, you're entitled to your opinion, but you're not going to get rid of it unless you have something to replace it. Ranting is not good enough. Again, you can't beat something with nothing. So if you hate the dollar, you think the dollar is weak, you think they print too many dollars, you think the dollar is going to collapse, fine. What are you going to replace it with? What's your replacement? And no one has a good answer to that question. It's not impossible. I mean, it could be the special drawing right, the SDR at the IMF. It could be gold. It could be a gold-backed SDR. It could take a digital form. I'm not talking about Bitcoin. I'm talking, the dollar is the leading cryptocurrency because the message traffic is encrypted and it's mostly digital. I got a few dollars, maybe a $20 bill in my pocket or something.
Swift
Philadelphia,
system. Talking about
yeah,
Swift.
Philadelphia would call that walking around money. But the point is, the dollar is the leading cryptocurrency because it's a digital encrypted message traffic payment system currency. And then you say, well, what about, people say Bitcoin or whatever. Or the Chinese yuan? Forget the Chinese yuan. What people don't understand is that when we say, 60% of global reserves are in dollars, they're not like pallets of $100 bills stashed away in the basement of the People's Bank of China. It's dollar denominated, but it's not dollars. You have to go buy an asset that's denominated in dollars, and it's primarily treasury bills and notes. That's what the Chinese own. So the point is there has to be an instrument, and in my example, treasury bills and notes and bonds that you can buy. So where's the Chinese yuan bond market? It doesn't exist. I mean, barely. Where's the Bitcoin bond market? It doesn't exist. In other words, none of these so-called alternatives have a bond market that you can actually invest in. Bitcoin has another disability, which is that this guy, Satoshi Nakamoto or whoever, supposedly invented it. I mean, somebody invented it. Are we sure it wasn't a deep state team from Raytheon? I mean, who knows who actually is behind this thing? But it doesn't matter. If you want to buy it, knock yourself out. But the point is, there's no yield on Bitcoin. You can call it a currency if you want to. Good luck buying a cup of coffee. They always find some coffee shop in Brooklyn where they'll take Bitcoin if you buy a cup of coffee. Great. One coffee shop in Brooklyn's probably boarded up today, but you can't buy anything with Bitcoin. A few people take it, but not really. But that's not the point. The point is there's no bond market, and there never will be. And here's why: the inventors of Bitcoin capped out the total issuance, and as you get to progressively higher levels of issuance, and we're about there now, the math gets more difficult, the energy input gets more difficult. If you want to be a miner, it just gets harder and harder to pull a Bitcoin out of thin air. Okay, well, if you have a cap on your currency, but the economy keeps growing, which we expect it will, that's inherently deflationary, meaning each unit of this buys more of this. Each unit of Bitcoin buys more and more goods and services because the goods and services keep expanding and the Bitcoin stays fixed. And that's the reason for why a lot of smart people, whoever, Glenn Hutchins, Ray Dalio, all these guys, say, well, it's got to keep going up. Well, no, because yes, there is that deflationary bias that's built in, which is a huge mistake. It shows that these math geeks don't understand monetary theory. But if you have a deflationary currency, which it is by design, you're never going to have a bond market. Because why would you borrow money in a currency that keeps going up? You want a currency that keeps going down. Borrowers love inflation. If I borrow $1 million and then inflation comes along and cuts the value in half, I'll gladly pay you back because it's easy because I only have to pay back half the money in real terms. So if you have a deflationary currency, you're never going to have a bond market because nobody wants to borrow in a currency where the value of the currency goes up because you have to pay back more in real terms. And if you don't have a bond market, you can't have a reserve currency because there's nothing to invest in. These are the things that people don't get. But like I say, the millennials and Gen X or Gen Z rather, and some billionaires want to play in Bitcoin. In the 50s, it was a doo-wop song or a dance song we used to dance to in the junior high school gym. It was called "Shout, Shout, Knock Yourself Out," and I think it was Dion and the Belmonts. But the point is, knock yourself out if you want to invest in Bitcoin. But it's going to crash. It has no. You can't spend on anything and you can't invest in it. You can buy the Bitcoin, but there's no bond market, and there never will be.
Great points. Last question for your book, and I'm coming back around to your book. What's the normal guy do to try to thwart the great new depression? I evidently buy your book. I've been listening to you for 30 minutes, which is fascinating, but we've just scratched the surface of your book. I'm sorry, I wish I could go longer. But what should the common person do to get ready for the new Great Depression?
Well, it's all in the book, Greg, and I'll give you a more specific answer to that. But I have great conversations with my editor, the folks at Penguin Random House. I'm with the Portfolio imprint. They're very, very supportive of me. We have a good dialogue, but we argue every now and then. And they said, Jim, you're going to write about the pandemic and the depression. It has to have a happy ending. You got to have something for the readers so that it's not all doom and gloom. I agree with that completely, and we do. So I take you through the release of the virus. I take you through the lockdown. Lockdowns don't work, by the way. I take you through the new depression, why monetary policy will not work. We talked a little bit about that. Why fiscal policy will not work because the debt level is too high. We talked about that. But at the end, in chapter 6, I have very specific recommendations. I said, look, hopefully policymakers wake up, but if they don't, here's what you can do. So, for example, the good opportunity, obviously gold is an easy one. I recommend a large allocation to cash. People go, well, why would I want cash? It has no yield. Okay, but in deflation, cash could be your best performing asset.
Yeah.
Because remember, in deflation, the value of money goes up. So if you have $100,000 and there's 2% deflation, the real value of the 100,000 just went up to 102 in a world where maybe everything else is crashing. But the important thing about cash, it gives you optionality. Cash is the equivalent of an at-the-money call option on every asset class in the world. Because if you jump into, maybe you jump into real estate or you jump into a private equity fund, whatever it might be, and then we get more visibility and you find out you made a mistake. Like, oh, I don't want to be in that. Well, you're stuck. I mean, try getting your money back from Henry Kravis. I mean, he's a good guy, but he's not going to give you your money back, really. If you're the one with cash, you can pivot. You can say, okay, now I want the venture capital fund, or now I want more gold, or I want stocks if things turn out better than I expect. So cash has that embedded optionality, which is really valuable, and it reduces the overall volatility portfolio, so you can help sleep at night. I really recommend Treasury Notes, 10-year Treasury Notes. You got smart people like Bill Gross, Jeff Gunlock, Dan Isaacson at PIMCO, all saying this is the greatest bond market bubble in history. Interest rates are at all-time lows. They got nowhere to go but up. You're going to get short the bond market, et cetera. One by one, they've been carried out feet first because they were wrong about that. And here's why. Nominal rates are low, but real rates are not low. And real rates are what count in terms of stimulating the economy and how people make investment decisions. I borrowed money in 1980, my first mortgage at 13%. My mother cried. Her first mortgage, I think, was 2%. But I said, Mom, I'm paying 13%, but inflation is 15%, which it was at the time. So my real rate is negative 2, not positive 13, but negative 2. Plus, taxes were 50%, 50, and my interest was tax deductible. So I had another 7.5 point tax benefit. So my after tax, after inflation, real rate was negative 8. So I say, yeah, Mom, I'm paying 13%, but it's really negative 8. The bank's paying me to take the money. Well, negative 8 is a really low real rate. I'll grant that. But real rates right now, maybe negative 50 basis points if you take the 10-year Treasury note minus inflation, 50, 60 basis points. That's not low. That's high. You need to get real rates down to like negative 3, negative 4 or more if you want people to start spending and lending again. And we're nowhere near that. So rates can go negative, and the yield to maturity and 10-year note can go negative. If you ride that rate down from it's about 95 basis points today,
right,
down to negative 50, let's say, you're going to have huge capital gains. So I recommend gold, silver, residential real estate, not commercial real estate. Too early for commercial real estate. It hasn't hit bottom yet. So I recommend gold, silver, residential real estate, cash, some private equity, and 10-year Treasury notes. That's a portfolio that will protect you against inflation and deflation.
And you're not worried about the rate. We've had 0.6 something on the 10-year Treasury for, I don't know, a long time. And then it went to 0.9345. And you think that's just a blip, that the trend is down, not up.
Yeah, I mean, as Pierpont Morgan once said, that he was asked about stock prices, and he said they will fluctuate. The rate backed up a little bit, but you can't imagine a world where the 10-year Treasury note is at 2% because the economy, you'd have 25% unemployment.
Oh yeah.
In other words, if you
Correct.
think inflation's coming, sure, but inflation's not coming. That's very clear.
Deflation, not inflation.
Deflation.
On the pre-order list, I'll put the link up. It comes out next week, and you pre-order it. I'll put it up there for you. Jim Rickards, thank you for joining us today on USAWatchdog.com. Very interesting. You got to really listen closely to you. You talk fast, you think fast. That's great. It's a compliment. But thank you very much for coming on USAWatchdog.com and telling us, what you think is coming in 2021. Deflation, buy gold, maybe have some cash. Thank you very much. Jim Rickards, the 5-time, working on his maybe 6-time best-selling author, and the new book is called The New Great Depression with the mask on it, George Washington on the dollar. Jim Rickards, thanks for joining us today on USAWatchdog.com.